Well, hi guys, welcome back to this Moneycontrol live stream. You're watching IPO Watch with me, Nandita Khemka, and today we are focusing in on WeWork India IPO, a name that you must have really heard about. It's a leader in the managed workspaces segment, a flexible workspaces segment, and it is of course making its way to the last 3,000 crore rupee IPO has opened up for subscription today. The IPO price is anywhere between 615 to 648 rupees a share, and of course, we have the management with us right here in our studios. Mr. Karan Virwani, MD and CEO of the company. Lovely having you right here in our studios, Karan. And congratulations on the IPO. You've got 1350 crore rupees via the anchor book, if I'm not mistaken. Yep. And you have marquee names. I think some of the list, names of the anchor investors are going through pretty strong interest. Goldman Sachs, Allianz Global, SocGen, and even marquee domestic names. All these domestic mutual funds like ICICI Pru, HDFC Mutual Fund, Motilal Oswal. Both globally and domestically, you've got a very good response via the anchor book. Good start. How confident are you that the IPO will get a very good response from the retail end of the market as well?
Firstly, thank you for having me. And like you said, this confidence from the anchor book just shows you the quality of the business, the growth opportunity left in the segment itself. Sure. From where we are, and the confidence that everyone has and where we're going to go. So we're feeling very good. We focused a lot on making this business highly profitable, but also extremely high quality in terms of our product, our services, the type of customers that we have. And we're in a segment that is clearly a sunrise segment and is going to basically fuel India's growth or help businesses in India grow over the next few years. And just feeling very good about where we are. Retail, I am pretty confident will understand that. And if anyone has walked into our space or seen our space or is working at any company that is in our space, what we're all about.
Sure, of course, all of us have heard, of course, and used WeWork offices also yes. Some point or the other. But of course, this managed workspace industry, as you mentioned, is a sunrise sector, so to say, fueled by shifting work preferences, especially post-COVID. There's huge demand for flexible workspaces and, collaborative environments as well. Tell us, how is your business model different from the existing players in this industry?
Sure. I think there are like 4 or 5 key differentiators, but really what we see is, like you mentioned, companies of all sizes, whether you're a small, mid-size or large company, completely going hybrid in the way that they think about their working styles, thinking about their growth, which means there's no longer a one-size-fits-all approach even for a small business or a large business. And today, we as WeWork India have built a platform that is able to cater to all of those requirements. So key differentiators, I think, starting with the brand itself, global recall, category defining. Our members get access to all WeWork locations globally. You get, with being a WeWork member here, you can access almost 600 locations all over the world. You'll see that our assets are in the top grade A buildings in top grade A micro markets. This is where we believe almost 95% of the demand is today, even today. And we have some of the grade A corporates, like someone like JP Morgan or Amazon use us. Some of the best startups in India like Zepto and Meesho have used us. Some of the best Indian corporates use us. And then finally, if you look at the scale of our financials, right, from a revenue, from a profitability standpoint, we are far above some of the other operators. And it's really a factor of all those few things that I just mentioned at the start. You can come to us for a desk for a day, going up to an office for multiple years that is highly bespoke and customized for you, and really everything in between. And I think that's one key differentiator where most of the market is trying to just do large scale, customized spaces or managed office as it's called. While we are doing that and it's a growing part of our business, we still have this entire WeWork platform that is not just India specific, but it can give you access to global locations also. And when you're a global business growing, having a standardized experience, having someone who can give you space across the globe, and especially in India, which is such a big hub for global businesses, no one else can do that apart from us.
Sure. You mentioned some of the key names, your clientele, the likes of Amazon, JP Morgan, etc. So, enterprise clients form a large part of your revenue. Give us a sense of your client breakup as well.
Yeah.
Is too much concentration towards enterprise clients? Should that be looked upon as a risk? And how are you looking to diversify your client base?
Yeah. I think if you look at both the presence and the mix, right, it really just mirrors what commercial leasing demand is across the country anyway. So, the largest employers today continue to be global businesses and some of these Fortune 500 companies. That's where most of the demand is, and they're all growing within the top 8 cities. All the talent is migrating into the top 8 cities. So 80% of our mix comes from enterprise customers. Of that, 36% almost are GCCs. And again, of that, 25% of the total 100% are Fortune 500 businesses. We don't have any customer concentration across the board. And some of the best companies in the world are using us.
Sure. Let's talk about your concentration in terms of cities as well in India. 8 cities and, Hyderabad and Bengaluru, I think they are your key, cities where you have the highest exposure. Are you looking at increasing exposure to perhaps a Mumbai or the NCR region? Or would you say that these two markets where you are present predominantly, would that remain your mainstay?
So like I said, our presence mirrors what the commercial demand looks like across India. Actually, our biggest city is Bangalore, then Mumbai and Gurgaon are close second. Hyderabad, Pune, Chennai are growth markets where we're seeing a lot of demand now starting to kick in. They're also slightly lower price and lower cost markets compared to Bangalore and Bombay. So what we will always do is follow the demand. If tomorrow there are newer cities that suddenly become places where these companies who are already our tenants want to grow, and also our landlords or developers start to build quality supply there, we'll 100% get into those cities. As of today, our focus is to just go deeper within the current cities that we're in, because that's the way we're able to give a network effect, we're able to get efficiencies in operations, but also it's really just where all that talent is and where all these companies want to continue to grow.
Sure. So basically growing deeper into the cities where you're already present. That's
right.
the strategy.
Yeah.
Okay. Let's talk about the financials as well before I come to occupancy rates, etc. You've just turned profitable in FY25, right? I was just going through your FY26 first quarter numbers as well. There's a bit of a loss, but that's narrowed down from the same quarter last year.
Yeah.
FY25 was the first year of profitability. Do you think you have reached that inflection point where you will see profitability sustain here on? Or do you think there would be some periods where you could perhaps see some losses?
So, these losses that you're seeing really are book losses based on the Ind AS accounting standard that we've had to adopt, as we become now a public company. And, if you understand that standard, it shows your lease rentals essentially below EBITDA, which is why on a reported basis, you'll see our EBITDA levels at like 63 or 64%, almost 1,200 crores of reported EBITDA, and then these losses is because the leases are treated essentially as liabilities and almost take an EMI type treatment where it's front loaded with interest, and depreciation. So if you're expanding or we continue to expand the business, you will see that hit will happen. However, we because we're operating now at scale, and actually the adjusted EBITDA is really what you need to look at, which is roughly about 22%. This is after all lease rental costs and all of that are taken into, which is really like an IGAP, what we look at in an IGAP accounting standard. So on an IGAP basis, we've been profitable for the last 3 years, down to a PBT PAT level, like significantly profitable. Because of the Ind AS accounting, the book losses will, in periods be heavier depending on the type of expansion that we do, because of the way that the leases are treated. But we are in a good place that we feel that in this year, even operationally, even with this hit, that we will be able to even show the book profit operationally. I say that because it's not reflective of the cash profit or the cash flow that we pay to the landlords. It's just upfronted in the actual accounts. Yeah.
Okay, got your point. But let's talk about the margin picture as well. Given the rise in competition, do you see pricing pressure coming in going forward? And in that sense, do you have a roadmap to defend your current margins, and also give us a picture of the kind of margins you expect over the next 2 to 3 years?
Sure. So I think as of today, as of FY25, you'll see on almost a 2,000 crore revenue, we generated a 420 crore adjusted EBITDA margin. This is adjusted for the lease rentals like I was talking about. That's about a 22% margin. The industry is roughly in a 10 to 12% of the similar comparison. So we're already from a margin profile almost double that of the industry, itself. That being said, if you actually just look at FY24, we had an average occupancy of roughly about 80%, but delivered a 20.4% EBITDA margin. This year, FY25, or the previous year, we were actually at a lower average occupancy because of capacity that we had brought on. But even with that slightly lower occupancy, we delivered a 22% margin. So if you just adjust the occupancy back, you'll see that the margin in the business has already expanded, significantly. And once those new centers ramp up and then get back to how our other centers do, it's just a period of time when that takes place.
How long does it take for a new center to turn break-even?
Yeah. So over the years, from somewhere in the mid-70s range of break-even point, we brought the business now to a mid-50s to 50 to 55% break-even point. We typically hit that occupancy within 4 to 6 months, and within 12 months, which is what we consider as a mature center, we reach 80 to 85% occupancy. So within a period of 12 months, the asset itself can generate close to 30-35% EBITDAs. We have some centers at 95-100% occupancy that at a center level is delivering very high margins for the business. And you spoke about competition and pricing pressure. I think if you look at us as a scaled operator across India in this segment, which is really the mid to premium segment, we don't compete too much with some of the other operators. From a pricing standpoint, a lot of the market will be between 7 to 10,000 rupees a desk. We are at 18 to 19,000 rupees a desk. With some of our services, we almost realize 22,000 a desk. And that's really a factor of the product we deliver, the location that we're in, the service that we're offering, and also the value of flexibility that you get, which I think most other operators are trying to just go down enterprise managed office model, where you just do large scale space for longer term commitments. And when you give longer term commitments, which we do also, you do have to compromise a little bit on price. But by having these WeWork spaces, ready to move in spaces where we can offer flexibility and scalability, you're able to command or get something for providing that flexibility.
Sure, for a premium. Tell me about your occupancies. Of course, you alluded to it that it had, of course, come down slightly, right? Going forward, how do you plan to ramp it up?
It's really just a factor of moment of time of capacity addition. If you see, last year we added about 27,000 desks, the highest ever expansion ever, even since before COVID. 16,000 of that came from October to basically April of this year. So within 2 quarters, you had a huge amount of expansion that came in. Which is showing in the Q1 numbers with the slight dip. We already see those moving up. I think what you need to see is our mature buildings and the historical performance over the last 7 years, that every time we open a center, within 12 months it gets to 80, 85. And if you just look at that and apply it to all the ramping up centers, you'll see that, it's not the occupancy will finally get up to those levels, but we'll again bring on new capacity, and there will be dips and ramp up periods in this business. What will change though is as the mature buildings become a larger and larger part of the portfolio, the new addition will suppress both occupancy and margins less and less, right? Because you'll not be able to keep adding the same percentage within a year, and so that way the occupancy will ramp up.
All right. Okay. In terms of your revenue growth, the top line growth, I was going through your financials. 2,000 crores, that's where it stood at in FY25. Do you have any targets in mind? I know, obviously, you'll not be giving us any guidance, but do you hope to maintain the same CAGR in terms of revenue growth, or is there a plan to better it? I'm just trying to get something out of you in terms of your top line growth.
So, look, I think that if you believe, firstly, that India is going to grow over the next decade and is going to reach this 5 trillion and then, further than that, what's going to happen is a lot of entrepreneurship, a lot of business activity, and Indian and global businesses still continuing to hire in India to boost the services part of the business and all of that. We are going to be the enablement platform for that entire growth. And today, the flex industry is growing at roughly about 20% year over year. We are the leaders in that. We want to push that further, and we think it can, we can. So, at the very least, we'll try to match or go a little bit over industry.
Okay, a little bit over. So, that's the key word for me. Obviously, I'm not getting any numbers here. But you have a fair bit of IT services clients as well, right? Any impact that you've seen because of the slowdown that has gripped the IT industry and the recent H1B curbs around that?
I mean, just because we're in the mid to premium segment of the market, we actually have almost 0% IT services. Actually, most of our member mix, which is, in the technology space, are global tech units or global capability centers that are building in the technology space, which is about 33% of our business. If you look at the data, you'll see that while IT services headcount of entry-level jobs, which are really in low-cost spaces and also low-cost locations, has been impacted the most. The same time, GCC hiring in India has gone up almost 20%. There is a clear premiumization both in what space companies want, but also the Indian employee is not a back office call center employee anymore. They are fully skilled developers, managerial staff, and really running global businesses both out of India and globally. And as that shift happens of Indian workforce moving up the value chain, they will want better quality spaces. There will not just be desk jobs, but there will be more ideation, building culture, building innovation. That's the progression that we're going to see. And that's what we are seeing, at least in our space and our tenants.
Sure. Let's also talk about the rentals. How often do you see revisions, and are there any breakups in terms of luxury, premium, etc.? Give us a sense of that.
Yeah. We sign almost 95% of our spaces in grade A assets with some of the best developers in the country, likes of Prestige, DLF, Rahejas, Embassy. These are all the developers that we use and have multiple locations with. We typically sign 10-year leases, and every 3 years there's an escalation of between 12 to 15% depending on the deal and the lease that we have. Now, and we typically give about a 3 to 5 year lock-in within that 10-year sort of period. We then put in capex, we design the spaces, we break it up into different SKUs with small, mid-sized, large companies can take space, highly customized for certain clients as well, and then really fill it up and ramp it up. And we see that almost 60% of our growth is actually coming from internal members themselves growing. They are now giving us between 28 to 31 months of commitment, and we have a renewal rate of upwards of 75 to 80% depending on the month or the quarter. That just gives you a highly scalable business that has a really fast growing customer base very organically. And while people are coming for the value proposition of flexibility, they actually end up staying extremely long because of the value that we're providing to them as a service, both from a space, scalability, the experience that the employees get while at a WeWork, and the ability to grow without, as an operator, thinking about the headache of this infrastructure and inconvenience that comes with it.
Are you planning to add? I mean, how are you leveraging AI to diversify your value-added services basket?
Yeah.
I mean, do you have any plans to that effect
I
as well?
think it's a great question, and probably the first question we've got on this. We use and have built technology better than any real estate company, I would say, in the country today, and definitely I think better than any flex operator. We have proprietary tech that we've built in-house that allows us to analyze space, the way that people are using it. Is it being used the way that we designed? This allows us to go in and then finally optimize the space so we can get better utilization. A lot of that is done through some AI and ML interventions. We have now a platform that we built to be able to source real estate a lot smarter. Just to open these 70 locations, we would have seen almost 1,200, 1,300 buildings, in the country. So the amount of data that we have to show why a building can be profitable, is it going to perform the way that we want? All of that is sort of built on a tool now. The same thing with pricing. We're able to figure out pricing a lot more dynamically, and we're going to be working on that. So, yeah, we're not a tech business. Just to be clear, we do leverage technology a lot, though, and the North Star of all of that is customer experience and figuring out how to grow revenues and margins. That's really why we use it.
Sure. Last couple of questions, really, in terms of capex. I think you have somewhere around 372 crores invested as of FY25.
Yeah.
Give us an outline of how you expect, how much you expect to invest going forward, and how would they be really funded, through internal accruals or external funding? Because none of this proceeds, the IPO proceeds are not coming, fresh proceeds are not coming to into the company, right?
Yeah.
So how are you looking at the
if you look at last year's, like you said, 370 crores, that really went for a 27,000 desk expansion that we did, a build out of 27,000 desks. Our cost per desk has now dropped even from there to about 140 to 130 per desk. We, looking at about a 20,000 desk addition, sort of year over year from that. So let's say roughly between 250 odd crores to 300 crores of capex will be like a standard kind of rollout that we have. If we see demand, like a lot of times through the year, we'll get these large enterprise demands, managed office demand, where we have to go over and above what we had planned. We will deliver that as long as it's, as long as it's bringing in revenue into the business. Now, if you look at just last year's EBITDA, roughly 420 crores of cash flow that the business generated. Since then, we've also paid off a large amount of debt. So that cash flow plus the growth in that cash flow that you will see in this year itself is enough to sustain the capex outlay, to take care of the debt, and also give us some surplus cash, as the business grows, to keep building on the liquidity. Finally, we're accessing or can access very cheap debt today, much cheaper than we've had in our past, and we hope post the IPO and post the rate cuts also that it will further reduce the cost, which is a smart way for us to deploy capital and balance both accruals as well as some amount of debt.
Extra funding, yeah. So last question, really, any scope for any kind of acquisition going forward? Is there a way to expand in organic way?
Yeah, look, I think the industry is very fragmented. 500 operators exist, but only 5 to 6 are at scale. We being the largest, we definitely feel like there is opportunities for consolidation. but there are certain parameters that are very important to us: the quality of the asset, the quality of the customer. Is it something that we wouldn't be able to just build if we deployed, certain capex? I mean, if you look at just the 20,000 desk addition that we're doing on a year-over-year basis, is significantly larger than most of the long tail of operators in their entire portfolio itself. So that would not, really interest us. It would need to be something that really adds a boost to the growth and either helps us get into a segment that we aren't in, or that would take us a long time to build. And we'll see.
Any such segment that you're targeting which you're not present in right now?
Nothing right now.
Okay, nothing right now. But with that, I would like to thank you for coming here to our
Thank you
studios
so much.
and interacting with us. All the best for your listing, and I hope to connect very often now with your
Yes.
quarterly results as well.
Yes.
So that you have much more media interactions with us going forward. But with that, we've come to the end of this edition of IPO Watch WeWork India. That was the IPO we were focusing on. Of course, a lot of other IPOs opening next week, the likes of LG, Tata Capital, etc. Keep watching this space, Moneycontrol, to get the lowdown from management as to what they plan to do post-listing as well. But with that, thanks a lot for tuning in. Stay tuned to Moneycontrol for all your other news and updates. I'll see you later in the day with market closing. Thank you for watching.